All right, we're looking at the Mr. Samir Hokolesque case study, topic ethics. Scroll down and read the first question. And this is going to be a short form response question. Question 1. Determine whether or not Hokolesque is compliant with the code and standards based on his updating of Horowitz's IPS. Justify your answer with a brief response. So 2 parts here. We need to determine whether we violate or not, or whether we're compliant, and then kind of give an explanation. All right. Samir Hokolesque is a senior analyst at a private wealth management firm in Istanbul, Turkey. Today, he is working with a client, Brian Horowitz. Horowitz has always been a conservative investor and worked hard over the past 30 years to save, invest, and reach a potential retirement in 5 years. This was something that did not seem probable when Horowitz began working with Hoko. I'm just going to say Hoko to make it easier. Nearly 20 years ago, Hoko is excited to see the hard work paying off. During their morning meeting, Hoko learns that Horowitz has just inherited some money from his maternal uncle. Hoko's firm has a policy in which it updates the IPS annually, unless otherwise significant financial life events warrant. So this would certainly be a life event. Getting a inheritance warrants more frequent updating. Hoko notes that Horowitz recently had an IPS update only 3 months ago. Hoko tells his client, "Well, I am truly sorry to hear about the loss of your uncle. At least it sounds like you are not too close to him, and the fact that he thought to leave you some financial assistance says a lot about his character. Clients who inherit large sums of money enjoy an increased ability to assume risk. The windfall diminishes the average yield required to meet current income needs. I will also update your IPS document to document the change in your financial circumstances." So that's good. I mean, updating the document to adjust the financial circumstances. "We will increase your equity allocation by 15%, mostly from your fixed income and a bit of your cash position." So the key thing here, I'm just going to pull in the answer so we can kind of start to talk through it. So we're going to say this is not compliant. And essentially the problem here is Hoko just kind of went ahead and said, hey, when this happens, clients always, when they inherit sums of money, they have an increased ability to assume more risk. That can be generally true. And it's always going to be better for a financial plan to have more money. However, he's just kind of jumping to this conclusion that we will go ahead and increase your equity allocation by 15%, mostly from fixed income and a bit from your cash position, which kind of contradicts, the client always being a conservative investor. He's worked hard to save over the last 30 years and wants to retire potentially in 5 years. Hoko kind of just jumps to the conclusion that, hey, we're going to use this money to invest, and that's that. We're going to increase your equity. Whereas now, I mean, there's a lot more factors at play here. I mean, maybe the client wants to retire a little bit earlier now that he has this windfall, and they're also conservative investors, so maybe they want to keep their allocation the same, just move up retirement. So we're going to say not compliant, and let me just kind of draw a line here. So this would be your answer. So Hoko failed to ask any deeper questions about the inheritance to better understand how the money should be invested or used. And then below this line, this is just kind of stuff that I added in that he might want to ask. So how much is the inheritance? And we're not getting the whole conversation, but how much does this increase their net worth? I mean, it says a decent inheritance, but maybe it only increases their net worth by 5% or less. I mean, that's not really worth increasing the equity allocation for that, especially. And then how would the client like to use the inheritance? Invest or save? And does this change any previous goals? Retire early, for example. So therefore not compliant. And again, you don't need to write out all these questions and everything. I was just kind of giving some examples of how to think about this question. So we get 1 point here, 2 points for the explanation, and there you have it. Question 2, determine which investment constraint Hoko has neglected to mention to Horowitz. Justify your answer. So we left off right here. The Realizing that Horowitz doesn't seem to grasp the talk about the IPS, Hoko sees an educational opportunity and mentions some specifics of the IPS. Horowitz has always shown an excellent ability to understand and adapt to teaching. Hoko states, the IPS helps establish an initial investment plan for the client based on the client's unique economic circumstances and investment constraints. The final product is a mutual understanding between the client and investor in an asset allocation. Investor constraints include, so we've got all the constraints here listed out. Liquidity needs, expected cash flows, investable assets, time horizon, regulatory, investor preferences, prohibitions, unique needs, and proxy voting responsibilities and guidance. So as it says, the constraints are kind of all the different things that can go into determining how the asset allocation is actually going to come out in the end. The big thing that they did not mention is taxes. So that'd be the determine part, determine which investment constraint we neglected to meet. And, that was kind of the big glaring one that was missed. I mean, the taxes can definitely have an effect on how we invest our money. So then justify your answer. So for the justify part, it's kind of justifying why it is an investment constraint. So taxes affect the returns of an investment. So it may, let me see, I think I typed this wrong. So it may constrain types of investments and or accounts used for certain investments. And then all other important constraints are mentioned. So that is our answer there. So we get 1 point for determining, 2 points for justifying, and yeah, there you have it. Question 3, determine whether or not Hoko has violated any of the code and standards concerning his performance presentation for the South African Fund. Justify your answer. All right, so we left off right here. Later that evening, Hoko begins to work on his advertising materials, which he has been too busy to get around to due to a slew of emergency meetings with clients he has had the past few weeks. Hoko uses the following performance data for his South Africa equity fund, in which he handpicks firms in the South African market that he believes will outperform. These companies are held for a minimum of 5 years and up to a max of 10 years. Hoko is exceptionally pleased with his performance, but wants to remain conservative in his calculations. All right, so we've got some very stellar returns here. Hoko updates his company website with the previous returns independently verified by a third party who has found the return calculations to be GIPS compliant. Hoko writes on his website, we are happy to present the following returns data to prospective clients. So far it seems like we're GIPS compliant, we're independently verified. All the performance presentation looks pretty good so far. As seen above, the South African fund has returned less than 20% in no years. That is fact, obviously. This is a proud testament to our rigorous investment research and due diligence process, which will continue to produce these results for many years. There's the red flag right there. However, we must note that this fund may not suit all investors. Those investors with less than a 4-year time horizon should consider other investment funds we offer, such as the Short-Term Opportunities Treasury Fund. So everything's good here until right here, which will continue to produce these results for many years. By saying we will continue to produce these results, you're essentially guaranteeing an investment return, which is certainly going to violate the code and standards. So bringing in the answer, we've got determine whether we violated or not. Yes, we violated. Justify the answer. Will continue to produce these returns. Implies guarantee of investment returns, which violates code and standards. 1 answer for determine, 2 for justify. Question 4. Determine whether the investment in Rapid should be made based solely on the context of its not fitting within Horowitz's IPS. Justify your answer with a brief explanation. All right, so we got to the end of this paragraph, so we'll start reading the last paragraph. A few days later, Horowitz reveals his plan to retire within a few years. At their pre-retirement meeting, Horowitz mentions that he has been given access to a unique investment opportunity in a food delivery startup, Rapid. Given that the firm makes it through the next 5 years of its startup phase, Rapid is expected to IPO. Horowitz states he doesn't think he will ever get another opportunity like this and that it must happen now. Hoko mentions that the timing just before retirement is not good and that he is confident this investment does not fit within the initial plan of the IPS. So the advisor, Hoko, is telling him that it's probably not, it doesn't really fit into the plan. Hoko notes that the investment size would likely not have a material impact on Horowitz's portfolio. So this one's pretty toughy. This one's pretty tricky because there's two kind of competing forces here. The investor wants to make this investment, once in a lifetime opportunity, it feels like for them. The advisor is probably advising against it, but at the same time, it's likely not to have a material impact on the portfolio. So the answer kind of inclines us to lean towards investing, allowing the investor to do so. And a lot of times, especially when you're working with individuals, a lot of investors have this itch to kind of use a small portion of their portfolio. So as long as you can keep them doing so where it doesn't impact their financial plan or retirement, for example, it's generally going to be okay, but just kind of making sure they know all the risks up front. So like we mentioned, as long as Hoko educates Horowitz on his risks, his opinions, which he does, and won't have an material impact on the portfolio, it's going to be okay to invest. So we've got 1 point for determine, 2 for justify. That's our answer. Where this would not become okay is the kind of material impact part. If Horowitz was saying, hey, I want to take half my portfolio and put it into this really risky startup, then the advisor would kind of need to put their foot down and not really allow it to happen.